You're looking at S&P 500 futures, anchored totally flat, right around 5,540.
And the Nasdaq 100 is, what, barely squeezing out a 0.1% gain here?
Yeah, exactly. And the opening bell is still an hour away. So it's Thursday morning, May 21st, 2026. And the implied open is telling us that the market is, well, it's nursing a massive NVIDIA hangover.
A huge one. I mean, the overnight session was completely dominated by that Q1 fiscal 2027 monster print.
Right. $1.87 EPS on $81.62 billion in revenue. Just absurd number.
Massive.
But the tape is completely sideways. So the active trader staring at this pre-market action, the question isn't how big was the beat?
No, the real question is whether the liquidity is about to, gap and go, or if the smart money is just quietly rotating out while retail is left holding the bag.
Right, and the pre-market volume we're seeing, it confirms this really harsh snapback from just blind momentum into granular price discovery.
The institutional strategy briefs from this morning, they don't show euphoria at all. They show a market that's actively weighing whether, hyperscaler capital expenditure guarantees future multiples.
Or if we've just hit peak saturation, right?
Exactly. We are looking at a classic liquidity trap right now where institutional distribution is basically masking itself behind a totally flat index.
Well, let's pull the data apart then, because the pre-market action on NVIDIA itself is violently bifurcated.
Yeah.
I mean, I'm looking at one block of institutional flow in the briefs that shows NVIDIA trading down 1.6%. And they're tagging it as a sell the news event because the 2027 product roadmap just lacked a shock and awe catalyst.
Right.
But then in the exact same minute ordinate dark pool data shows it pushing up 4.2% on an edge computing segment breakout. Like, how does that even happen?
Well, that bidirectional volatility, that is the literal definition of high volume churn without price discovery. You basically have two massive institutional camps colliding pre-market. The buy side is aggressively front-running this edge computing narrative, right?
Wedding that local on-device AI processing is the next frontier.
Exactly, the high-margin frontier. But the sell side is looking at that 26x forward earnings multiple, and they're categorizing the valuation as brittle and just aggressively taking profits.
But wait, I mean, I look at the $725 billion in committed 2026 AI infrastructure spending from the hyperscalers, Microsoft, Amazon, Google, Meta, and I see an absolute floor under this market.
Sure, on the surface.
I mean, a 77% year-over-year CapEx jump completely validates the agentic AI cycle.
Yeah.
You can't call it 26x forward multiple brittle when the top 4 tech companies on Earth are contractually locked into buying your hardware.
Well,
That's not a fragile thesis, right? That's a monopolistic utility. Why shouldn't a guaranteed revenue stream command a premium multiple without triggering all this chaotic pre-market churn?
because public markets don't price in guaranteed revenue. They just don't. They price in the second derivative.
The rate of growth?
Precisely the rate of growth. At $81.6 billion in quarterly revenue, the law of large numbers becomes your absolute biggest enemy. To maintain a 26x forward multiple, NVIDIA doesn't just need to maintain that $725 billion spend.
You need to show where the next trillion is coming from.
Exactly. The moment the spending flattens, even if it flattens at historically unprecedented highs, that multiple compresses. That's the peak CapEx risk the sell side is pricing in this morning.
Wow. Okay. Which means the active trader needs hard lines in the sand for the open.
Absolutely.
So looking at the briefs, they lay out a bull case gamma squeeze level at $162.50.
Yeah, that's the trigger.
If NVIDIA clears that psychological resistance on high opening volume, the dealer hedging flows will just trigger a reflexive feedback loop, right? We could potentially see the stock at new all-time highs by noon.
Right, but you got to watch the downside. The bear case floor is $148.
$148, yeah.
Failing to hold that level confirms that the price to perfection crowd is just executing a gap down exit.
And the broader implication here is capital velocity. I mean, if the AI hardware trade is splintering or running into this multiple compression you're talking about, that institutional liquidity has to find a new home.
It doesn't evaporate.
Right. It rotates down the tech stack.
Exactly. And we are seeing that rotation play out in real time with Snowflake today.
Ticker SNO.
Yeah, SNOW is gapping up 7.2% pre-market on a surprise product revenue beat.
Which is wild.
It is, but it looks identical to the late 90s telecom build-out. I mean, for the last 2 years, NVIDIA has been laying the physical fiber optic cables, right? The GPUs, the data centers.
And Snowflake jumping 7.2% signals we're finally entering the monetization phase.
Bingo. Enterprise spend is migrating up to the software layer to actually extract value from all that raw compute power.
So this is a second wave AI thesis in action.
Yeah, because software inherently offers way higher gross margins and, lower capital intensity than hardware. Institutions are looking at the massive CapEx burden on those hyperscalers and deciding, hey, let's pivot our exposure to the SaaS companies that will just rent that compute power to sell high-margin AI agents to Fortune 500 enterprises.
But it's interesting because the rotation isn't just seeking software,
Yeah.
right? It's also hunting for hardware value plays with an AI overlay.
Oh, for sure. Look at Apple.
Exactly. Apple is showing a massive pre-market volume spike today. The institutional flow is clearly front-running next month's WWDC based on this AI at the edge integration, the M5 Max Studio.
And those rumors of a split launch strategy for the iPhone 18.
Right. So the bull case breakout level there is $235 if it clears its 50-day moving average.
Yeah, but you have to be careful because the Apple play is ultimately a defensive rotation. Institutions want AI exposure without the 26x multiple beta risk of an NVIDIA.
Makes sense.
However, there is a severe macro headwind buried in the supply chain data here that could drag Apple right back down to its $218 support.
Wait, what headwind?
The very same hyperscaler spending that is propping up NVIDIA is currently consuming massive allocations of high bandwidth memory.
Oh, wow. Which starves the consumer electronics market of standard LPDDR RAM.
Precisely. I mean, the foundries only have so much wafer capacity. If TSMC and SK Hynix are prioritizing high-margin AI server memory for Microsoft and Google, they are actively restricting the global supply of mobile RAM.
That's a huge bottleneck.
It is. For Apple to execute a heavy AI at the edge strategy on the iPhone 18, they need significantly more onboard memory. If global RAM shortages delay that launch or even just compress Apple's hardware margins.
The $235 bull thesis instantly flips to a $218 gap down.
Exactly.
And that dynamic AI capital actively starving other sectors of resources, it's bleeding directly into the old economy industrials too.
Oh, heavily.
We're tracking Boeing down 2.1% pre-market on reports of a fresh FAA production audit targeting the 777 X-Wing assembly.
Yeah, and Boeing is just the perfect proxy for broken narratives in a capital-starved environment.
Right.
I mean, fixing severe regulatory and manufacturing friction requires massive capital allocation. But with institutional liquidity just laser-focused on funding the software rotation and these massive AI data centers.
Companies like Boeing are facing an exponentially higher cost of capital to fund their turnarounds.
Exactly. Management is trying to find a floor, but the market is just flat out refusing to subsidize their operational friction.
Which brings us to the stark bifurcation we are seeing in the broader macroeconomic data this morning. I mean, Walmart releases its Q1 earnings at 7 a.m. Eastern, and the relative volume suggests a pure flight to safety.
Oh, totally.
If they beat on grocery and e-commerce, it confirms consumer resilience and triggers a $74.20 breakout. Yet on the industrial side, Deere is showing significant pre-market weakness on cooling heavy machinery demand.
Well, you really have to layer the overnight central bank action over that divergence to understand the causality there.
The ECB.
Right. The European central banks signaled a hawkish hold overnight. That effectively killed the whole narrative of a coordinated global rate cut.
And meanwhile, the U.S. Federal Reserve remains entrenched in this shallow easing posture with a 3.50% terminal rate.
Yeah. So a hawkish ECB means European borrowing costs remain really punitive, which directly explains the cooling demand for Deere.
Because European agricultural conglomerates aren't going to finance fleet upgrades of heavy U.S. machinery at those interest rates.
Exactly. The capital expenditure cycle for industrials is completely frozen by monetary policy, while the tech sector just ignores interest rates because they are flush with cash.
That is the core mechanism of the bifurcated economy right there.
Yes.
The consumer is prioritizing non-discretionary essentials at Walmart, corporate agriculture is pausing capital upgrades at Deere, and the central banks are just refusing to provide liquidity relief.
Which brings us to the actual structure of the S&P 500 futures this morning.
The trap.
We are in a defined liquidity trap.
Yeah, the dark pool prints from the overnight session show really heavy institutional distribution. But the retail flow is entirely skewed to the buy side, aggressively chasing market orders on the back of those NVIDIA headline numbers.
And the institutional algorithms are utilizing that retail buy-side liquidity to quietly unload their positions right at the top of the range.
Basically locking in the rally's profits without tipping the bid-ask spread.
Exactly. In a liquidity trap, volatility expands, but net directional progress remains absolute zero.
So the battleground for the E-mini S&P futures, the ES, is incredibly tight today. Support is cars out at 7,370. Breaking below that triggers an immediate vacuum down to 7,200.
Yep.
And overhead resistance sits at 7,485. So the actionable strategy for the active trader today is to completely avoid the middle.
Do not trade the chop.
Right. Trading the chop between 7,370 and 7,485 will just chew up your capital.
The institutional mandate right now is to wait for confirmation. If the bulls cannot force a daily close above 7,100, it validates a double top formation.
And the strategy briefs note that failing to break 7,500 by noon today sets up the mechanics for a severe Friday slide.
Yeah, because momentum traders who bought the open will realize the volume is dead and just liquidate ahead of the weekend.
But, the S&P levels are just a symptom of the real dictator of the market today.
Oh, the macro overlay.
We have to address it because the absolute most critical metric on the board right now has nothing to do with AI, chips, or software rotation. It is the 10-year Treasury yield.
The bond market is always the ultimate arbiter of equity valuations. Always.
The TNX is sitting at 4.59% right now, pulling back slightly from a massive 16-month high of 4.7%.
Yeah.
And the U.S. dollar index, the DXY, is hovering at 99.1.
Yeah.
The strategy briefs highlight a severe pain trade developing here. It's driven by the fact that the retail market is entirely fixated on corporate earnings while completely ignoring the ground they are standing on.
Right. I mean, understanding the mechanics of a duration flush is totally non-negotiable in this environment. High multiple hyper-growth tech stocks are effectively acting as long-duration proxies for the bond market.
Because they are deeply intertwined through institutional risk parity funds, right?
Exactly. Those funds operate on strict volatility targeting. They balance risk between equities and bonds based on these really complex algorithms.
So when the 10-year yield rises rapidly, the bond side of their portfolio takes a massive volatility hit.
Yes. And to maintain their target risk parity, the algorithms are forced to dynamically de-risk their equity exposure. And because future earnings of high-growth tech companies are discounted at that newly elevated risk-free rate, their present value compresses violently.
Which means if we get a hot PMI print this morning and the 10-year yield spikes through 4.60%, it literally does not matter that NVIDIA just posted $81 billion in revenue.
Doesn't matter at all.
The risk parity algorithms will just blindly dump high beta AI equities to rebalance their books.
Don't trade the earnings, trade the discount rate.
Wow.
If yields surge toward 4.75%, the institutional rotation out of tech and into defensive cash or energy will be violent. The retail traders currently levered up in, secondary robotics and edge computing names, they'll be caught in a massive gap down.
Entirely confused as to why great earnings didn't prevent a sell-off. We started the morning looking at a staggering $81 billion beat from NVIDIA, but tracing the actual capital flows reveals a much more dangerous tape. The money is rotating out of hardware and trying to find refuge in software like Snowflake and defensive value tech like Apple.
But even Apple is constrained by the physical limits of global RAM supply.
Right. Meanwhile, the dark pools are masking distribution, central banks are pinning the industrial economy to the floor, and risk parity algorithms are basically sitting with their fingers over the sell button, just waiting to see what the 10-year yield does next.
And there's one final variable to factor into your risk models before the bell rings today.
What's that?
Well, the only reason the 10-year yield has pulled back to 4.59% this morning, the only reason this tech rally hasn't already been suffocated by the bond market is a macroeconomic factor completely detached from Silicon Valley.
Oh, the peace dividend mentioned in the brief.
Exactly. The market is aggressively pricing in the optimism of a U.S.-Iran peace deal. That geopolitical shift is cooling global oil prices, which in turn takes the pressure off inflation data.
Which finally gives the bond market an excuse to let yields drift lower.
Right, so ask yourself this as you position your capital today. If this historic AI tech rally is currently depending more on the geopolitical reopening of the Strait of Hormuz than it is on a $725 billion AI infrastructure spend, how fragile is this tape?
Are we actually pricing in the future of silicon innovation, or is the entire Nasdaq just a derivative trade on the cost of Middle Eastern oil?
That's the real question.
It really is. So watch the 10-year, respect the 7,370 support level on the ES, and whatever you do, trade the implied open, not the headlines.